Welcome to Greystone Capital Group, where we invite you to embark on an extraordinary journey towards a life of abundance and fulfillment. At Greystone Capital Group, we specialize in the transformative power of passive investing in commercial real estate. Your journey to financial freedom and a fulfilled life begins right here. Subscribe now and let Greystone Capital Group be your guide to shaping a brighter tomorrow.
Hello, everyone. Welcome to our show again. We have a great guest today, Kevin Bupp, and he's Sunrise Capital Investor. And Kevin, welcome to the show.
Hey, Jonathan. Thanks for having me. Excited to be here.
Thank you. Thank you. So tell us a little bit of your background and how you got started in real estate.
Yeah, no, we'll do it. I always joke and say that real estate found me. I didn't find it. So very happy and grateful that occurred back when I was 19 years old. So I'm 45 now as we record this, and basically at the age of 19, I met a guy, local guy to where I lived in Pennsylvania, and he was a real estate investor. He was about 25 years older than I was. And he owned a lot of rental properties in the area. And that was a very new world to me. Both my parents, we're a middle-class family. Both my parents worked, had their 401ks, which was their investment. They didn't have any investments outside of that. No one in my family was an entrepreneur or business owner. And so when I met this individual, that was like a new world for me. His name was David, and David went on to become my very first mentor and kind of taught me the business. But that was the age of 19. Went to a few conferences. Ultimately, by the age of 20, was in community college, attending bar in the evening, saving my money. And at the age of 20, I bought my first single family property at David's guidance. He kind of, walked me along the path. And, I learned a lot from him over the year prior that I worked for him for free. Basically, I went and worked for him for free and did anything he needed so that I could learn how he ran his business, what he said, how he said it, who he said it to. And that was it. That was where they started. So that was the age of 20, bought that first property. And then from the age of 20 to about 27, ended up just really building upon that business model. He was a single family guy for the most part. He owned some small multifamily, but he was a buy and hold. He always used to tell me, I let my tenants pay off my mortgage, and I also make a monthly positive cash flow on top of all my expenses. And that's how I live my lifestyle. And some of my homes I own free and clear, and that they have no mortgage on them, and that's my retirement. And so I thought, what the heck? Why am I going to reinvent this model? And I'm just going to do exactly how David told me to do it. And so by the age of 27, I built up about 122 single family homes, had a few hundred apartment doors as well. And so life was going great. And then 08 happened, lost most of everything, Jonathan. And I'm on phase 2 today. Phase 2 is started in about 2011, and fast forward, we've bought mobile home parks now in 18 different states. We've got parking garages and parking lots as well in a number of different states, and about $300 million of AUM, of assets under management at present day. So,
Great.
Yeah, so that was a condensed 20 plus year span of time. A lot happened in between there. Lots of challenges, lots of lessons learned. Again, had to rebuild after losing everything. But ultimately, the last decade plus, we've focused primarily on mobile home parks as the investment vehicle. And then also more recently, we started buying parking garages and parking lots.
Mm-hmm. So what did you learn from the Great Recession? What did you learn after you built all those single family houses? Did you lose every single family house? What happened there?
I wouldn't say we lost everything. We were down. I was down in Florida at that point in time, and in Florida, the values, when the market started crashing, the values crashed so incredibly fast. And so when things started kind of tumbling, we started trying to sell off, kind of fire sale properties, and we sold some. We were able to sell some, get out from underneath some of them, but the prices dropped so incredibly fast, and people truly just stopped buying in Florida for a period of time. Everything went kind of silent and dark. So we did lose a number of properties, and the biggest reason was it wasn't that we didn't want to keep them, we didn't want to try to work through it. But our strategy used to be, we'd go buy, 4, 5, 6 single family homes with private money. We had private investors that we had worked with. They would create a first lien mortgage on the property. We would renovate the home. 5 homes, we'd renovate a batch of them over the period of a couple months, and then we would go basically get a commercial loan, cross collateralize 5 or 6 homes, pay off those investors, and we'd go do that again. So we had a number of commercial loans that were tied to different batches of these single family properties, and the big challenge is that very different than today. The banks were not prepared for what was about to occur or what occurred in '08. They weren't prepared. They didn't have the internal infrastructure to deal with that many defaults. They didn't have a strategy in place on loan workouts or which borrowers they're going to work with, which ones they weren't. They had no structure in place. And so initially it was just hey, you either pay your mortgage or we're going to start the foreclosure process. Like there was no workarounds. There was no loss mitigation department or loan restructuring department. And so while we really wanted to work with the banks and we did our best to work through these challenges, inevitably what ultimately occurred is either the loan fell into foreclosure because we had a lot of vacancy issues back then too. A lot of folks left Florida. There was no jobs. There was an excess supply of inventory. A lot of new homes were built with no one in them. And so there was more homes than we had bodies here. And so we saw a major issue also with our vacancy went up quite a bit over that first year. And so we were having issues actually making the debt service. And so what happened in most instances, either the bank started foreclosure, they took the homes back, or we did a deed in lieu, or in some instances, they actually just called our loan due. They're like, hey, our balance sheet is in really rough shape right now. We're going to accelerate the loan clause on these particular properties, and we're going to you got to have us paid off in the next 90 days. Give us a date, and we couldn't do any of the above. I mean, none of those worked for us. We really just needed some. We needed some leeway. We needed some type of period of time of reduced payments. Yeah, reduced payments. Re-amortize the loan for a period of time. We needed some, which that started occurring. A lot of banks realized they're like, after going to 2009, 2010, they're like, we're in bad shape. A lot of banks failed, and so banks realized that we've got to work with borrowers. That we have to, and they put together programs. They put together loan restructuring programs, but it was too late for us. I mean, we basically had a year span of time where we tried to run damage control and ultimately lost pretty much everything. So even my primary residence. So it was it was a tough time.
That was a awakening.
Yeah, I would say so. I would say so.
Yeah. Wow. I never lost my home, so that's interesting. So where'd you move after that? You lost your home. Do you rent or something, or what'd you do?
No, it's a great question as well. So again, the courts were so backed up at that period of time, and while my home was literally in foreclosure for like 2 years, and so I literally just lived there and maintained it, and kept the power on, kept electricity on, kept lights, all that kind of stuff. And so I just lived there until basically the time came. And I actually tried to even restructure that when I tried to work with a bank. But the problem at that point in time was that my credit was so bad from all the other foreclosures that I wasn't a worthy borrower in their eyes. I wasn't I was too high of a risk. And so they wouldn't even consider doing a loan modification program on that home there. So, but it took about 2.5 years, I think, when it was all said and done, for them to work the entire way through the foreclosure process. So I lived there until then, and then had to go rent, like a lot of folks had to, like a lot of people had to.
Wow, that must have been hard, because I can't. That's a very difficult process. It's hard to go from a nice, beautiful home, into a small apartment, right?
Yeah. It was very humbling.
It was humbling, yeah. I guess they're like soul searching too, right? So what am I supposed to do next? What did you say to yourself to get that motivation or that confidence, actually, because you failed a big way, and then you said, how do I get back to 3.0, 2.0?
Yeah, no, that's a good question. It was really difficult, honestly, Jonathan. I mean, I one thing I did probably within the first 6 months, things were like spiraling out of control. The good thing is I didn't have a wife and I didn't have kids, and so my responsibility was me for the most part. Obviously, I had a big financial responsibility, but I didn't have kids that I had to worry about, or even a wife that I had to So it was just me, and I can a lot of times I'm like, I can take care of myself, like I can figure this out. But I would say that one thing that really helped me through it in the first 6 months, I really started focusing on health and fitness. And I was always worked out, always ate fairly good, and I was conscious of my body, but I really went into it 110%. Because I was like, what, every day I woke up, there was a new challenge I had to deal with. And I felt as though I need to be in like peak physical shape in order to, be able to mentally kind of work through, these. I know how long it was going to last. It ended up being about 3 or 4 years before we really sorted through all the mess. And so that was one way that just helped me sustain, helped me kind of manage every day that came at me. And as long as I felt good and I had mental clarity, most of those challenges I could kind of chunk down and work my way through them. So, I mean, that was the first way. But then the second, I started a couple other, I need to still put food on the table. I needed to, be able to, even though I wasn't paying my mortgage, I still had to be able to actually afford to live. And so I started a few other businesses related to health and fitness because I didn't want to think about anything real estate related. I was already running damage control and kind of managing it every day. And so I needed money. And so I went and started two other businesses. One was a social run club because I was like, you know what? I'm into health and fitness. I was doing a lot of running. I was running a lot of marathons and things like that. And so I wanted to do something that was in alignment with kind of this new passion I had for health and fitness. And so I started a social run club. We had, ended up expanding to like 40 locations across the country. And basically bars and restaurants would pay us on their slow night to bring, 30 or 40 runners in, and we'd do a social run and just hang out afterwards. And so that was a way to get my mind off of things, but also make some money. And I started a sports clothing line as well, which basically were, custom clothing for runners and run clubs and things like that. So while I didn't kill it and I didn't make, millions of dollars, both those businesses were profitable and they put food on the table, allowed me to keep that roof over my head for a period of years before really jumping back into real estate. And I just, the real estate thing, I never had the fire with these other businesses. I never had that fire in my belly. I never felt the way I did, with real estate. And so this is like 2011. I really started to get the bug again. I'm like, I saw there was a lot of opportunity out there, a lot of discounted properties. And everyone knows the old adage of you want to buy when there's blood in the streets, right?
Mm-hmm. Yep.
Buy low, sell high, right? And so now is the opportunity, right? There was a lot of opportunity in the marketplace. And so I went on like an exploratory mission. I went and talked to as many people as possible that were still in the business, in the game. And it's just trying to figure out what the new landscape looks like. What does lending look like? 'Cause when I say that I completely shut it out, aside from managing my portfolio in foreclosure, I pretty much shut everything else out. I didn't watch the news. I didn't pay attention to anything else. And so I had to kind of go in this new phase of exploring what was out there, what's the opportunities. And that's how I ran across mobile home parks. I met a guy that had been a commercial banker for many years, and he retired and bought a couple mobile home parks. And I had lunch with him, and he praised the asset class for 2 hours straight during our lunch together, so much that it intrigued me to go on my own journey to learn about the asset class and to go buy one. I was so excited about that asset class after I left that lunch meeting that I went and kind of promised myself I was going to buy one. And I did. It took me about a year. I bought that first mobile home park back in 2012 up in Atlanta. And since then I think probably purchased over 50 mobile home parks. We've gone full cycle on 20 of them. Have a fairly significant portfolio today, and it's been a great asset class. And again, I don't know if I would be where I'm at today if it wasn't for all the bad things that actually happened because of '08. I don't know if I would have ever come across mobile home parks, which has really been the 2.0 that you're asking about. Like that was 2.0 was mobile home parks and allowed me to rebuild and do it in a much more substantial way, but even a more sustainable way than what it was prior.
Mm-hmm. So I guess it's interesting because life's like a journey. You don't know what happens. You never forecast you losing your own foreclosure in your own home, which is surprising. But you never expected that, right? And you never expected losing most of your home, you think from your house that you built up, worked so hard for.
That's right.
So, but if you don't have that bad experience, you never got the good experience, which is, hey,
That's
maybe
right.
mobile home park is for me, maybe not single family houses, right? So you say you don't buy single family house anymore and no more just mobile home parks. How do you feel about that?
That's right. Yeah. No, I mean, in the single family thing, it's interesting because I saw some cracks in that system, at least our business model of just buying large scale single family. And don't get me wrong, I know there's obviously large institutional groups that do it today in a very large format. But back then the technology wasn't as good. You didn't have like digital lock boxes. You didn't have some of the efficiencies that exist today. Back then, and the 120 properties I owned were in 5 different counties. They were spread out, and so between leasing agents and showing the properties and the maintenance and repair being all over the place, it created so many inefficiencies from a management side and I noticed that probably a couple years prior to us leading into '08. But you get set in your ways. The system was in place and we were buying properties and building the portfolio. But really, if I was honest with myself, I should have had a heart to heart back in like 2005 or 06 and said like, Kevin, like, come on, man, like this is good, but it's not great. It could be, but there's a better way to do this. And honestly, I owned some apartment complexes as well. And that never became a core part of my business. Don't ask me why. I don't know why. But when I really compared the two, the apartment complexes did much better financially than the single family homes because they had a lot more efficiencies. They had, we had a couple units that were like 30 and 40 units all in one location. And they were just much more efficient to operate than the single family. So if I would have been smart and honest with myself, I would have stopped buying single family. I would have sold all that and I'd have just bought apartment complexes. And I don't know why I didn't, but 2.0 mobile home parks, which are basically apartment complexes, they're just horizontal apartment complexes. That's our business today. And it is much better and much more sustainable and more efficient than that of the single family game. And I know folks that make money in single family. I get it. But I think there's an easier way to scale a portfolio. There's just a better way to do it than buying a home at a time. That's my opinion.
I like home because it's a niche, and it's also just owners, they might do seller financing, creative financing, and it's easier to deal with if you can source it good and have a good relationship with the owner. And you could make a money because it's not like buildings, it's more like just, so it depends how you operate it, but it's less riskier in that sense. And
that's right.
Yes, less overhead.
What you mean is like most of the time we don't own the mobile homes. We just own the property and the infrastructure. And the folks that own the mobile homes, the residents, they own their own home and they rent a lot from us. Their home sits on a lot and they rent a lot from us. So there's, in that sense, there's not a lot of repairs and maintenance. There's not a lot of just day-to-day maintenance because if the plumbing breaks, if the roof leaks, if the air conditioning goes out, they're calling the plumber, they're calling the electrician, they're calling the HVAC company because it's their unit and they own all the mechanicals associated with their unit. So we don't get involved with that, which if you own an apartment complex or a single family home, that's all the landlord's responsibility, which adds an element of just logistics into the equation, but also additional costs and expenses, with repairs and maintenance.
And I think, do you do lease to own too, or no? On some of your mobile homes, do you like?
We do. Yeah, I mean, we do, but I would say that it's kind of we kind of have a 3-tiered system. If we have an available unit in the property, and let's say that we own the home, or I'll give you a better example. A lot of times we'll go bring brand new homes into a community, and like we just brought in, I think 10 last week into one of our communities. We had some empty spaces, so we brought 10 brand new homes in. And so first and foremost, our strategy is to sell those units outright to the new buyer. And then we'll just collect the lot rent. Again, they maintain their own unit. Life is good. But with that being said, this particular market where we brought 10 homes into, I don't think that we'll be able to absorb all 10 of those units before winter truly hits, which is basically right now up there. I mean, it is in Illinois. It gets very cold in the next 2 months, and we don't want vacant units sitting there over the winter time. And so in that strategy, more than likely, we'll probably end up selling 3 of them outright. And then the plan B is to lease with an option to buy, and then we'll convert those folks at a later date, but we'll get them in there with a little bit of a down payment. Maybe not as much of a down payment as that they would have to put down if they're buying the unit, but we'll put them in on like a lease to own strategy. And then we'll work to convert them a year or two down the road into being a homeowner. And then plan C is going to be a straight rental. So I know between plan A, plan B, and plan C, we can absorb all 10 of those units probably in the next 4 to 6 weeks easily. And then over time, we'll look to convert those lease to owns, and even the rentals. We'll look to convert those rentals into a for sale unit a year or two down the road. For example, like the rentals, the ones where we have to do a straight rental, when it comes up for first renewal, we'll give them the option to buy it. We'll show them, we'll help them get a mortgage if they want to. But if they don't have an interest in doing that, and we know we have demand for homes for sale, we just won't renew the lease for a second term. We'll let them lease it for a year. We won't renew it. And then we'll put that home on the for sale market and get it occupied by a homeowner. Because our objective in the long run is to not own any of the units. So we always try to sell them off to the end user.
Right. So it's kind of like an asset light model where it's great because I like it because the fact that you own just the grounds, you just make sure the common area is running well. And the crucial thing is you have good tenants, not some bad tenants that will affect the community. So that's right. The crucial thing. So as long as you screen it very well, and you just maintain just the grounds and the areas, and so it's very low risk in that sense. Then
that's right.
That's why it's solid cash flow. That's what I like.
If you buy, I mean, if you buy it right, solid cash flow. Yeah, that's correct. And it should be low maintenance cash flow as well. If you don't own any of the homes and the infrastructure, one thing that I think a lot of folks overlook, the business model is simple in theory. However, a lot of parks were built, 40, 50 years ago. And a lot of folks overlook the quality of the infrastructure. While you might not own any of the mobile homes, the residents own the units. So you're not responsible for their ACs and the roofs and all that, but you're responsible for the common areas. And while visually you can tell a condition of roads. And so you can say, hey, these roads are in bad shape. They need redone. But a lot of folks fail to go deeper, and they fail to go and inspect the actual water lines and the sewer lines. And that's the infrastructure that could really cost you a lot of money down the road. It could be so much that it could basically make a good deal, what looked like a good deal on paper, into an absolute nightmare because you didn't go deep enough to realize that the sewer lines were already failing, and you're going to have to replace sewer lines throughout the entire community, and that's going to cost you $1.5 million.
Wow.
Same with the water lines. And then you've got parks that might be on private utilities, like a well system that services the entire park, or it might be a private sewer system. And those things, when they fail, they're incredibly expensive and can cost you hundreds of thousands or millions of dollars. So you got to make sure you do your due diligence and that you're buying something that's got good infrastructure, it's been maintained, because those are the things that can truly just wipe you out completely.
Yes, exactly. So your DD is very important because
absolutely.
And sometimes private wells, sometimes there's a septic tank, and sometimes they have certain regulations. So if it's certain ways of disposing it, and there's environmental issues, that once you find those can be very expensive.
That's right.
Because some of them I know, and I've seen one in the that's in kind of like a lower class C area, and it has some kind of issue with some kind of like disposing it. I was like, And I was like, no, I said no, thank you. I didn't want to go deeper into that one. I was looking at one of them. I was like, no, I was afraid of that. I was like, no.
So. Yeah, no, I've seen a lot of horror stories. I haven't been a part of any that have had private septics or sewers or wells that have gone bad, but I've known folks that have bought communities that have had either a well system collapse, like maybe we had two wells, and one of them was collapsing and they didn't do the due diligence, and so they basically half the park couldn't get clean water. And if you can't provide half the community clean water, then they can't live there. Unless you're going to go buy bottled, hundreds of thousands of gallons of bottled water every day for the next however long, because it's not easy. You don't just go drill a new well. You've got to go through a very detailed process with the municipality, with the EPA. I mean, like to put a new well in. A lot of times it might take you, even a fast process, it might take you 6 months to put a new well in. So that could ultimately, force people to move out of your community and absolutely kill your cash flow. I mean, your income might get cut in half.
Yeah, in half. Yeah, so you lose, like, you're basically losing money if that's the case, because you have half of them will be like left. You have 50% occupancy.
Yeah, and even after you fix the well, the people already left. Now you got to find new people to come back in,
which is not easy.
That's not easy.
It's not easy to lease up. It takes a long time.
Yeah, it doesn't happen overnight. Yeah.
So great, Kevin. And so now you're focusing. So what's your goal now in the future? You still want to continue mobile home parks, or are you good right now? Or what's your level now?
Yeah, we always buy. I mean, we're always buying. We've had some great growth years last year and this year. But we're always buying new communities that fit our criteria. We're always slow and steady growth. We buy assets that make sense and they're in great locations. And if we can't find that, we don't buy. So, but these last 2 years have been really good to us. Lots of folks have not been buying. Lots of operators are, maybe made some poor decisions a couple of years ago when interest rates were low and they were overpaying for properties. We did not do that. We did not participate, which has really provided us a good runway these last 2 years to buy some just great assets at great prices, and great locations, and not have as much competition. So we'll continue buying. Mobile home parks is the one asset class. As I mentioned as well, we started buying parking lots, parking garages a couple of years ago. And so we've got two properties that will close out by the end of this year. We've got one really large institutional mobile home parks, about 500 spaces in size. We'll close that out here in the next couple of weeks. And then we have a very large parking garage that's in Charlotte, North Carolina, that will also be closing out here in the next couple of weeks. So, and then we'll roll into 2025 and see what that year brings.
Great. And how do you raise your capital? Through private money lending or investors fund? Or how do you do that now? Yeah,
we run a Reg D 506C offering. We run it in a fund format. So, high net worth accredited investors is who we raise 99% of the capital from, and that's how we've done it now for going on 10 years.
Oh, because of 506C, that's what you do.
Yep.
Okay.
Mm-hmm.
Okay.
Correct.
Great. Well, great, Kevin. Well, thank you very much for coming on the show. I hope people reach out to you. They want to come and connect with you.
Yeah, the best way, just you can go over to investwithsunrise.com. There you can learn about myself, our company, what it is we do. There's also a contact us now page there. You can, reach out and the message will find its way to me. And then outside that, we're pretty much on every social channel. If you just type in my name, it's pretty easy to track me down. Kevin Bupp, Bupp is the last name. And I don't know if there's many other Kevin Bupps in the world, so you shouldn't have a hard time finding me.
No, there's not too many. So, but thank you. It's great you having on the show, and thank you for your time.
Thanks, Jonathan.